Welcome back to Investing Talk Podcast.
Today we're looking at Algorhythm Holdings.
As usual, before we start, subscribe, like, and comment to this video to support the show. Okay, let's unpack this because, frankly, I have been staring at this ticker for 3 days, and I still think I'm hallucinating. We are talking about a company ticker symbol, RIEE, that until very recently was literally the singing machine company.
It is definitely a head-turner.
Head-turner is the understatement of the year. We are talking about a company that sells karaoke machines. You know, the plastic box you buy at Best Buy to ruin Sweet Caroline at a house party. That was their entire identity.
And a successful identity for a while, to be fair. But, not exactly a high-growth sector.
Right. But now, suddenly, they are an artificial intelligence logistics play claiming to solve billion-dollar inefficiencies in the trucking industry. I mean, talk about a key change. We went from microphones to supply chain optimization overnight. It sounds completely absurd on paper.
It does.
It feels like a fever dream or some, corporate buzzword bingo.
Yeah.
And here's the kicker. The stock chart is telling a very, very different story right now.
It sounds absurd until you actually look at the size of the problem they are trying to fix. And that is where the hook is for investors. We aren't just talking about shipping boxes or moving pallets.
Right.
We are talking about a global logistics industry that creates waste on a scale that is genuinely hard to comprehend. We are looking at approximately $1 trillion lost annually to inefficiencies.
1 trillion, you mean with a T?
With a T. And the biggest culprit, the absolute villain in this story, if you will, is something called empty miles.
Right. I've seen this term empty miles floating around the research reports. But let's break that down for the listener who isn't a logistics manager. What does that actually look like in practice on the highway?
It's startlingly simple, and that's why it's so frustrating. Imagine you drive a generic semi-truck from New York to Philadelphia to drop off a shipment of furniture. You get paid for that leg. Great. But now you're in Philly. Your next load is in Baltimore, or maybe it's back in Newark. You have to drive that truck 100 miles to get to the next pickup.
And during that drive?
During that drive, the trailer is empty. You are hauling air. You're burning diesel, you're putting wear and tear on the engine, you're emitting CO2, and most importantly, you are paying the driver's hourly rate. But you are moving zero freight.
So you're generating zero revenue.
Zero revenue.
So it's pure cash burn.
Yeah.
It's like opening a restaurant and throwing away 30% of the food before you even cook it.
Exactly. And the statistics are brutal.
Yes.
The industry estimates that about 1 in 3 trucks on the road right now is driving empty.
1 in 3. That feels incredibly high. You're telling me if I look out the window at the highway, 30% of those massive trucks are just taking a scenic drive.
Essentially, yes. Just that specific problem, the empty miles, is estimated to cost the U.S. freight industry alone about $400 billion a year. It is a massive efficiency gap. So when you look at Algorhythm Holdings, yes, the karaoke to AI pivot is jarring. It feels weird. But their pitch is that their AI platform called SemiCab solves this specific problem right now.
Okay, so what here is basically if they can fix even a tiny fraction of a $400 billion problem, the karaoke past doesn't matter. They could have been selling pet rocks before this. If the math works, the math works.
Precisely. If the tech is real, the legacy business is irrelevant.
All right. Let's dive into the fundamentals then.
Yeah.
Because I need to understand how we got from point A to point B mechanically. You mentioned they sold the karaoke business.
Yes. This is crucial for the pure play thesis. If they were still trying to sell karaoke machines while building AI software, the market would discount them as a confused conglomerate.
Of course.
But they cleared the decks. They completed the divestiture of the legacy singing machine business to the Stingray Group.
That was their main revenue driver, though, wasn't it? That feels risky.
It was, but look at the quality of that revenue. Consumer electronics is a brutal game. It's inventory heavy, you're dealing with returns, shipping hardware from China, and the margins are just razor thin.
Right.
By selling that off, they transition the company into what we call a pure play AI model. They are now solely focused on logistics tech. They strip the house down to the studs.
Okay, so they are lean.
Yeah.
But if they aren't selling microphones, how do they keep the lights on? What is the actual business model now? Because AI isn't a business model, it's a tool.
It's a two-pronged approach, and they are quite different.
Yeah.
First, you have SemiCab India. This is their managed transportation services arm. They are securing contracts with major players there, Fortune 500 fast-moving consumer goods companies.
FMCG. So we're talking toothpaste, snacks, soda, the stuff that moves high volume, low weight, constantly.
Exactly. India is a fascinating market for this because it is incredibly fragmented. It's chaotic. If you can use AI to bring order to Indian logistics, you can do it anywhere. The model there is sticky. They move from pilot programs to national contracts.
Yeah.
They essentially take over the headache of managing transport for these massive enterprises.
And the second prong?
That's the U.S. side, SemiCab USA. This is the holy grail for investors. A recurring SaaS model software as a service licensing their Apex platform. This is where the margins could theoretically get very interesting because you aren't paying the drivers directly, you're just charging for the brain power that organizes them.
Okay, theoretically is doing a lot of heavy lifting there, and I want to put a pin in the financials because we need to look at those closely. I have some concerns. But first, I want to understand the moat. Every company says they have AI now. My coaster probably claims to use machine learning to brown the bread. What makes SemiCab actually different from a standard digital freight broker like Uber Freight or Convoy?
That is the right question. Most digital freight brokers are just matching. It's a digital bulletin board. I have a load, you have a truck, let's make a deal. It's transactional.
Right.
SemiCab is doing predictive optimization.
Predictive optimization. Break that down for me. How does that differ from matching?
They call it the fully loaded round-trip concept. The AI doesn't just look at the trip from A to B, it looks at the entire network of shippers and carriers simultaneously. It predicts where capacity will be needed 3 steps ahead.
So it's playing chess while everyone else is playing checkers.
In a way, yes. It stitches together a continuous loop. So instead of A to B, then driving empty to C, the AI builds a route that goes A to B, B to C, and C back to A with freight on the truck the entire time.
The whole loop.
The whole loop. It creates a collaborative network. It might take a load from Pepsi to go one way and a load from a paper company to come back.
So the truck never runs empty.
Theoretically, yes. And the value proposition is hard to argue with. Because the truck is always full, the carrier earns more money per day. They aren't wasting time. But because the efficiency is so high, the shipper actually pays less.
Wait, shippers pay less and carriers earn more. Usually that's a zero-sum game. Usually if I pay less, the driver makes less.
It's only a zero-sum game if you don't eliminate the waste. The waste, the empty miles, is who is paying for it right now. The shipper pays for them in higher rates, and the driver pays for them in lost time.
Right.
By removing the waste, both sides win. That creates the moat.
Network effects.
Huge network effects. Once a client integrates this and sees their shipping costs drop because the AI is optimizing their routes, the switching costs become very high. You aren't going to go back to a manual broker who charges you 20% more just because.
Okay, I see the vision. I really do. It's a compelling story.
But
where, and you knew there was a but coming. Looking at the filings here, I'm putting on my auditor hat.
I can see you frowning at the balance sheet already.
I have to. They are listed as a smaller reporting company.
Yeah.
We aren't talking about Microsoft here. The cash position improved after they sold the karaoke business, sure, but they're still burning cash, right?
They are. The transformation is expensive. You have to build the tech, secure the contracts, ramp up the sales team. You don't just flip a switch and become profitable.
And the financing. I'm seeing a securities purchase agreement with Streeterville Capital. I looked into the details. That is asset secured with subsidiary guarantees. That is not exactly free money. That's expensive capital.
No, it's not free. It's a necessary bridge. Streeterville provides capital, but it's secured against the assets. It's a lifeline to get them to that scale we talked about. It's typical for high-growth, cash-burning phases, but it does add risk.
And profitability.
Currently, margins are pressured. You have net losses from continuing operations. You have SG&A selling, general and administrative expenses that are high relative to revenue right now. But the thesis, the reason the stock is moving, is that as the AI scales, those margins expand. SaaS margins are typically 70–80%. If they can flip the revenue mix to that Apex platform in the U.S., the bottom line looks very different in 2 years.
If, that is the magic word.
Yeah.
But look, the market clearly thinks that if is a when. Let's pivot to the charts to see how the market is reacting.
The word I would use is soaring.
It really is. I'm looking at the price action from just this past week, specifically Friday, February 13th, extending from Thursday. It's like someone lit a match in a powder keg.
It's a classic breakout. We are seeing the stock make higher highs. It's pushing through resistance levels that have held it down for a while. There is very strong psychological buying pressure here.
And it's not just the price, right? It's the volume. Volume is the lie detector test for price moves.
Exactly. The volume is incredibly telling. We saw the stock popping and trending overnight in the pre-market and after-hour sessions, that is usually a sign that people are scrambling to get in. It implies urgency.
When you see that pre-market action, it usually implies that news is driving it, not just technicals. It's not just algorithms trading against algorithms.
Correct. This isn't a gamma squeeze from options data. We don't even have specific options flow data on this to point to yet. This is driven by the narrative. It's driven by the news cycle regarding the platform scaling.
Right, implied flow. Retail is seeing the headlines, maybe some smaller institutions are starting to nibble, and everyone is trying to position themselves before the opening bell.
It creates a feedback loop. The price jumps on news, traders see the momentum and jump in, which drives the price higher. It's volatility fueled directly by the business updates.
The charts are hot, but what are the headlines saying? Because sometimes the chart moves and the news is nothing. We've seen meme stocks fly on zero news. But here, there seems to be substance.
There is definitely substance. If you look at the top stories from February 12th to the 14th, the narrative is incredibly consistent. You have headlines like, Algorhythm stock is popping, what's going on? And Algorhythm Holdings SemiCab platform enables scale freight volume by 300% to 400%.
400% scaling. That is the number that jumped out at me.
That is the number the market is buying. When a company says, we are live and we are scaling freight volume by 400%, that is hard to ignore. It suggests the product market fit is there. It suggests they aren't just selling the software. People are actually using it.
So the mood is bullish.
Distinctly bullish. The sentiment analysis across the board is positive. Investors are buying the transformation story. They love the idea of a tech turnaround.
I have to point out what I don't see, and this is the skeptic in me again. I'm looking for validation from the big boys. I don't see any major analyst upgrades for 2025 yet.
That's fair. It's still under the radar for the major banks.
I don't see price targets from Goldman or Morgan Stanley. I don't see any Form 4s showing insiders buying clusters of shares with their own money. I don't see 13F data showing institutions accumulating massive stakes yet.
It's too early for a lot of that. The institutions, the smart money, they move slower. They need to see a few quarters of clean earnings before they can justify the risk to their investment committees.
Maybe. But right now, this looks like a retail momentum move. It's the individual investors reading the press releases and buying the story. The smart money, if you want to call it that, seems to be watching from the sidelines.
Or they're waiting for the next quarterly filing to confirm the numbers match the press releases. That's standard for a company of this size undergoing such a radical pivot.
True. And we should mention the competition briefly. We saw some news about Universal Logistics recently.
Yeah, largely neutral news. They are a traditional player. The fact that RIME algorithm is getting all this attention while competitors are just kind of existing shows that RIME is capturing the imagination of the market. They are winning the attention economy right now.
Hold on, we need to look at the risks before we get too excited. I mean, attention is great, but attention doesn't pay the bills. And hype doesn't pay back Streeterville capital.
Agreed. What is your biggest worry here?
Risk number one is just financial reality. We talked about it, but it bears repeating. Net losses are persisting. Transformations are messy and expensive. If they burn through that cash pile before the SaaS revenue ramps up, they are in trouble.
Right.
2024 showed declining operating margins. That is a trend you need to reverse immediately. You can't scale an inefficient business model. You just scale your losses.
It is a race against time. Can you scale revenue faster than you burn cash?
Yeah.
That is the classic startup dilemma, even though this isn't technically a startup.
And the financing, that Streeterville deal,
Yeah.
it's debt-like. If things go south, that debt becomes a heavy anchor around their neck. But here's the one that really made me pause. I dug into the 10Q and 10K reports. They flag material weaknesses in internal controls.
Yes. The auditor's red flag.
For a skeptic like me, that is a siren. It means there are issues with how they track and report their financials. It doesn't necessarily mean fraud, I want to be clear on that. But it means the systems aren't tight.
Yeah.
When you are trying to execute a complex pivot and scale 400%, you need your internal controls to be rock solid. If they aren't, you risk reporting errors, restatements, or worse, making management decisions based on bad data.
It's a valid concern. It adds a layer of execution risk. It essentially says, we are building the plane while we fly it, and we aren't totally sure the fuel gauge is working perfectly.
Exactly. And that leads to risk 3, execution. This is a show-me story. It's one thing to say you can beat the massive legacy 3PLs, the third-party logistics companies that have been doing this for decades. It's another thing to actually do it. Relationships matter in trucking.
And we have seen competitors in this space stumble. Integrating AI into legacy supply chains is hard. It takes time. If the integration gets delayed, or if those big Fortune 500 clients in India decide to pull the plug after the pilot because the drivers don't like the app.
The cash burn becomes a massive problem.
Correct. And we should note, there are no confirmed M&A talks. There are rumors, sure, people speculate that maybe a bigger fish buys them for the tech, but there are no product leaks, no confirmed discussions. If operations fail, there is no guarantee of a golden parachute.
So no white knight waiting in the wings. They have to survive on their own merit.
They do.
So how do we grade this transformation? Because I see the huge potential. I see the trillion-dollar TAM. But I also see the check engine light blinking on the dashboard with that material weakness.
It's a balancing act, but if I have to give a verdict, I am leaning into the upside. I think the divestiture of the karaoke business was absolutely the right move. You cannot be half in on AI. You have to burn the boats.
So you like the commitment?
I like the commitment, and I love the market. Here's the elevator pitch. You have a company transforming a $1 trillion inefficiency market empty miles with a pure play AI model. And importantly, it is not vaporware. It is live, it is deployed, and they are claiming 300 to 400% scaling.
That is a strong pitch.
I'm giving it a bullish score of 7 out of 10.
7 out of 10, okay. Why not an 8 or a 9?
The internal controls and the cash burn. I need to see 1 or 2 quarters of clean execution. I need to see those margins stabilize. The risk is real.
And why not lower? Why not a 5?
The momentum. The breakout is real. The addressable market is just too big to ignore. Even if they only capture a sliver of that $400 billion empty mile problem, this company is worth multiples of what it is today. The risk-reward ratio is skewed to the upside.
So what's the play for the listener?
I see this as a swing trade into the next earnings. You have 3 to 6 months of runway where the narrative is driving the stock. Ride the momentum, but keep an eye on it. If they prove the SaaS model works in the US over the next year, this turns from a swing trade into a multi-year hold.
So, dated for now, but be ready to marry it if they clean up their room.
That's a perfect way to put it.
It's fascinating stuff.
Yeah.
It really highlights how quickly the market can change its mind about a company when the story changes from consumer electronics to AI revolution.
And it raises an important question for everyone listening. How many other zombie companies are out there? Companies that look dead on the surface, selling outdated hardware, but are actually sitting on valuable tech or IP, just waiting to shed their old skin. Algorhythm might be the first of a new wave of legacy pivots.
That is something to chew on. That's the score. If you want more deep dives like this, make sure to subscribe, like, and comment below. We'll see you in the next one.